So most of the investor or we look at returns like fund has given return of 7%, 10% or 15%. You are saying that looking at returns is can be a misleading thing.
Return is important because ultimately it will move from that. What one needs to be careful and be mindful, right? Where I use the word very carefully, it's being mindful of inflation and taxation because
Many people believe in investing in India itself. They don't want to invest outside. So what is your take on it?
so it is not to take away the India growth story, and I think that is something which is something an investor needs to do. Right? So the first investing journey has to be in India. What I'm looking at is that
Everyone calls themselves as a long-term investor, but then when you find that 2-3 years and if the schemes are not doing well, if the investments are not doing well, so you start doubting your investments altogether. Should I exit? What should I do?
when you are being impatient, in fact the word itself tells you, I am patient. Equity market will always test your patience, more than anything else. So, and there have been
Welcome back to the investing mindset. In the last episode, we talked about the 5 mistakes that stop people from creating wealth. But knowing what not to do is only half of the story. The bigger question is what investors should actually do instead. To help us figure that out, we again have Juzer Gabajiwala, director at Ventura. Hi, Juzer. Welcome back to the investing mindset.
thank you, Harshita. Good to be back.
Last time we covered the mistake one should avoid while investing. So this time I'm going to flip the conversation. What is that one should follow to create wealth in a good way?
So yeah, I think we covered last time the what investor actually needs to avoid. I think if the investor is able to avoid those mistakes, half the battle is won. But by just winning half the battle, he has not achieved too much, right? So he needs to move a bit ahead. So I think one of the first thing which he will need to be mindful about is inflation and taxation. So that is something which he will need to be mindful about.
So when we say mindful about investment, so most of the investor or we look at returns like the fund has given return of 7%, 10% or 15%. So you are saying that looking at returns is can be a misleading thing.
No, so what return is important because ultimately it will move from that. What one needs to be careful and be mindful, right? Where I use the word very carefully, it's being mindful of inflation and taxation because from the return, how much component is getting eaten away by inflation and how much is going away by way of taxation. Okay. So let us split it up into two. Let us first take inflation. So what I mean by inflation is that not the RBI announced inflation or what the government is publishing. What is relevant for you is going to be your inflation. So I will look at my inflation. Now, what do you mean by my inflation? So one is that a senior citizen is concerned, he's more worried about medical costs. Whereas if there is a younger, couple, they would be more worried about the education costs. So for them, education inflation is relevant, medical not that much. For a senior, he will say education inflation doesn't matter to me at all because everything is done over there. The other thing is that there is a cost of living and one is a lifestyle cost. So one needs to be very mindful about what is the lifestyle inflation. The lifestyle inflation is always higher than the cost of living inflation. The second thing what a person also needs to be mindful about is the taxation. Now, different instruments have different taxes. The instruments whole methodologies have changed. A lot of things have changed over the past so many years. So one what needs to look at is that ultimately what is the real return he is making. So if you take your example, you took 7% or 10%. So whether you take 10% return, now out of 10%, how much tax am I paying? So that's the first thing you need to reduce. So you'll say I'm paying, 2% of it is going in tax. So 10 minus 2, your post tax return is 8%. So you first arrive at the post tax return. Now, from that, inflation is a factor which plays a role. Now, if you decided that your inflation is say 6%, so 8 minus 6, 2% is your real return. So that is what an investor will need to focus on. And that's why when I said that, one needs to be mindful of inflation and taxation. So, that is the first thing what a person needs to be careful and mindful about. The second thing which an investor will need to look at is that whether he is in the wealth creation loop. That's what I call it.
Okay, so this is something new. Like, what does this terminology actually means? If we can, go deep into it. So, if you can explain.
Yeah, so one of the most important wealth creation tool is that you will be looking at equity. Okay, now whether you are looking at direct equity or are you looking at mutual funds, there are many investors who are only looking at direct equity and they ignore mutual funds. Both the products are good and important. So, what I mean is that when somebody is starting his career and he's just earning, so how is he converting his income to wealth? Because everyone looks at that, equity requires a larger amount of money to invest. So one of the best way to start is that if you are earning regularly, you're spending regularly, then why not invest regularly? And you cannot get a better tool than the mutual fund, which allows you to, start with as low as even 500 rupees or 1000 rupees, depending upon what your wallet permits you to do. So that is a good way to convert your income to wealth. As you progress up the ladder, you can actually start looking at, how you can create from that wealth to more wealth. So you can start looking at direct equity. So at one side, you are buying a portfolio. If you get more interested and you have the ability and the knowledge, you can start looking at direct equity also as a option to invest. And there you can, actually put in larger chunks of money, because you need to understand that an equity return will either beat a mutual fund return, or it will underperform. A mutual fund will never beat equity, nor it will be as bad a return. It will be a steady because it is a portfolio. So that is one thing one needs to be careful when he's investing. So when I look at both these products, and many investors come and tell me, no, they have full knowledge, right? So a stock is like an apple. Okay? A mutual fund is a fruit basket, right? So you're getting everything in that. For being successful in equity investing, what I believe is that you require knowledge, you require luck, and you require patience. You require all of them, one third, one third, one third, right? Now, given the mutual fund, the knowledge part will be taken care of by the fund manager, because you are relying on his expertise in terms of the investment. I think not much of luck is required. The luck is required from the whole equity market perspective. The other thing what you need is patience. So that is something which you need to have for mutual fund as well as for equity investment. Now I'll give a very small example, and we just took as an example as HDFC Bank. HDFC Bank started somewhere in '95. Around the same time, HDFC Mutual Fund also had one of their first schemes. So if we take that time horizon of around 30 years, HDFC Bank was a single stock, right? So that gave a return of somewhere around 22 odd percent. Plus you can add dividend return over there. The HDFC Flexi Cap gave a 20% return, right? Now, yeah, you are good enough because the stock was a concentrated bet, right? The mutual fund was a diversified bet. The mutual fund was invested across funds. HDFC Bank would have had more wilder swings, more volatility than as compared to the mutual fund or the HDFC Flexi Cap fund. Your sacrifice what in terms of return was around 2 to 3%. which is not very bad from a diversification point of view. And that's where the third thing which one needs to focus on, that you have to use diversification as a strategy.
Correct. Now, saying about the diversification, we all understand that diversification is needed when it comes to investment. But still, everyone has that one favorite of theirs, or that one winning stock or scheme. Where if you like it, or if the fund is doing good, you tend to invest more into that. So, how does one should be? What should be the behavior of an investor?
So, what I mean by diversification and why it is relevant is that you will always have economic cycles, right? We will have something what is called as sectors will also rotate. So sometimes you had in 2000 we had the IT sector, in 2010 we had the banking sector, in 2020 it was the manufacturing. So the sectors were rotating. You also have asset classes rotating. So you would have at times equity doing well, at times you would have gold doing well, at times you would have the real estate. So across asset classes do well, and it will keep on changing. At times you'll also see that even whether it is a mid cap doing well or a large cap or a small cap, right? So each of the decade also goes through a sectoral change. So if you just give you a brief, is that from 1995 to 2000, roughly around that odd years, we had the old economy stocks. So the old economy is basically meaning the cement and commodities and those stocks, FMCG. So that were doing well. From 2000 to 2010, we had a good run on the IT services. So you had the TCS and Wipro and Infosys and all doing very well. Then from 2010 to 2020, we had the private sector banks, which were doing well. New banks came in, and the HDFC Bank and all those banks did pretty well. 2020 to 2025, there was focus on make in India. So you had the capex cycle. So you had manufacturing and those entities, doing well. So that is how you will see that there will be sectors which will keep on rotating. So you will need to diversify across sectors, across companies, so that across asset classes, so that you are having an optimal return.
Correct. So I was about to ask you the same. Like, does this, happen in case of different asset class also, like gold, silver, equity?
Yeah, so if you would have seen, and of recent, we had been talking about the silver run, right? I mean, the silver and gold have been having a good run. So in 2025, silver has gone up by nearly 170%. But in 2021, silver was the lowest in terms of the asset class, and it was for a very longish period of time underperforming. It required just 1 or 2 years to make up for it, right? Similarly, if you look at in the equity, so when you look at small cap was a underperformer in 2022, right? It was at the bottom in terms of the asset class, and in 2023 and 24 it had a dream run. So you will keep on seeing that something may remain bottom, and suddenly after a year or two you may suddenly find it is on the top, but you will never be able to time it appropriately. So it is going to be very difficult that if you cannot say that it is 1 year at the bottom, so next year it will be on the top, right? It can remain bottom for one more year, right? So what is the next thing which you require to do? You need to be patient.
Seriously, I mean, being an investor, one has to be patient. That's for true. But this term, like, being patient, it sounds very simple, but it is very hard to, resist. Like, everyone calls themselves as a long term investor. But then when you find that, 2, 3 years, and if the schemes are not doing well, if the investments are not doing well, so you start doubting your investments altogether. So if I have to ask you, it has happened with me also that I invested in some, I did some investments and which didn't do good for 2, 3 years, And then I was, questioning myself, should I exit? What should I do? Should I continue or not? So, what is your take on it?
So, when you are being impatient, in fact, the word itself tells you, I am patient. Okay. So, you have to read from the word itself is telling you to be patient. So, I think you should draw a lot of strength from there itself, because equity market will always test your patience, more than anything else. So, and there have been umpteen examples. I'll just share with you one or two examples. One is Hindustan Lever. It has been a blue chip company, very good, doing extremely well. So nobody could, doubt the pedigree of the company, the promoters, or anything in terms of their performance. But it went through a lull of around 10 years of nothing. So for 10 years, the stock price did not move much. It was hardly, it was quite flattish. It is not that the company was not performing. So company was doing reasonably okay, but the stock market was not seeing any value in that. But in the next 14 years, it actually covered up everything and it went up 8x, right? So a stock will really test your patience. Now, if somebody bought at the beginning of the first 10-year period, he would have waited for 10 years with a zero return, right? He would have exited, and then he suddenly realized that now the stock started moving, and somebody got a 8x return, right? So the investor behavior will keep on changing, right? It will test your patience. It will depend upon whether you are going to give in first or are you going to be holding on to it. Right? So that is very important. And the same story also got repeated in uh, ITC. ITC also had a period of 5 years of negative, nearly negative returns, right? And it just took 2 years for it to cover up and everything. So what you also need to understand is that if you do a fixed income instrument, it will take you, let us say if it is giving you 7%, it will take 365 days for you to get that 7% return. In equity, you can get that same return in just one day. So you can have a scenario that the stock may not do anything for 300 odd days. I mean, whenever the market is open. But if it just has one or two good days, and if it has just gone up 7%, it'll make up for the return of the entire period of that year. So the stocks will always behave in that manner, right? And it will move in that way itself.
So, does the same thing apply for mutual funds also, SIPs as well?
Yeah, so I think this is a very good question, what you have posed. And in fact, SIP tests the patience much more, than a stock. In stock, you may keep on seeing the movements up and down, right? In a mutual fund, specifically when you're doing a SIP, you may not see anything happening for 3 to 5 years. You will not see that money growing so drastically because you're just investing every month. But the moment you cross that threshold of 7, 8 years and 10 years, and suddenly you will see that entire thing will just rocket. So I'll just give you again an example, and I'm just taking the same example of HDFC Flexi Cap Fund, more so from the point of view that it has been there now for nearly around 30 odd years, where the scheme is still continuing. So if somebody has started a SIP of 10,000, right, in 1996, maybe 10,000 was a fairly large amount, not super large, but a reasonable, good sum at that point of time. And let's assume the person continues with that 10,000 SIP. And if he has done it, continued for this period of 30 years. So that means he has done his investment for nearly 360 months. So 360 times 10,000. Today, he has invested around 36 lakhs, right? So that is the investment which he has done. Do you think he has seen a single line going up? No, it has not happened like that. If you see from 1996 till 2026, where we are today, we have seen nearly everything in the market. There was a 2000 IT meltdown. We have seen again the markets going up again, and then we have seen the 2008 when we had the global financial crisis. Then afterwards again the markets went up, but at that time the markets really crashed. So the investor has seen his portfolio drop. Again, you had a reasonably bull run. Then we had a lull period. We had change of government. So we have seen UK moving out of the Brexit. We have seen change of government in India. We have seen change of government across the world. We have seen wars. We are currently experiencing two wars going on at present. You have witnessed COVID, which was not thought about, right? So I think in this last 30 years, nearly everything has been witnessed in terms of now the person who has lived through that journey, he has gone through each and every highs and lows, right? But even if supposing you assume that that the investor was patient, again we are still using the same word, right? Today his the amount which he would have collected on this 36 lakhs is nearly 17 crores, right? Which is
Huge.
nearly 58x of the amount which he has invested, right?
That's really a very huge amount. I
Yeah.
mean, literally, patience serves you well, I guess.
So that is something which one needs to be careful about. The other thing which an investor actually needs to do also is that he should be also looking at investing outside India. Yeah. The world is much more bigger even outside India. So that is something which one should look at.
But having said that, investing in India itself, like, investing in India itself is a strong growth story. So, like many people believe in investing in, India itself. They don't want to invest outside. So, what is your, take on it? What would you like to say about it?
Yeah. So what you're saying is right. Right? So it is not to take away the India growth story, and I think that is something which is something an investor needs to do. Right? So the first investing journey has to be in India. One, what I'm looking at is that so from a perspective of even diversifying beyond India, when you have done a fairly large amount of investment already in India, you need to look at global. Okay, the reason being is that the world is much more bigger outside also, right? And you have many sectors, you have many companies which are into products which are not manufactured in India. India's largest company is, Reliance Industries, and worth I think nearly around $207 billion, give or take here and there, when we did the last calculation. Now, if you look at Apple or Nvidia, right? Apple products are available globally, but if you have to buy Apple, you'll have to go to the US. Right? Apple itself is worth nearly 4.4 trillion odd dollars. I think somewhere around four and a half plus. Right? So see the size. Right? Nvidia is bigger than Apple. So Nvidia is into a lot of things which we will not be able to buy. Right? So you are getting to invest in companies which are not present in India at all. How do you participate in, let us say, you want to buy Amazon? We are all buying products on Amazon. But if you have to invest in Amazon, then you'll have to go to the US markets. It's not only about US markets. There are companies which are way beyond US. So you have TSMC is a famous company in Taiwan, right? Huge into semiconductors. Then you have South Korean companies, you have Japanese companies, you have certain commodity companies in Brazil, which those commodities are not available in India. The other thing what you also get is there are many times names which you have not even heard of. Like Costco is a big wholesaler in US, right? It is a DMart at a much more global, bigger. I'm just giving a
Correct.
crude comparison of DMart, but Costco is huge, and in fact, it is nearly double the size of Reliance. Right? So we need to look at even those entities which are there outside. But for getting a diversification, we go global on that to get benefits of companies like you are there are many biotechnology companies which would not be present in India. The other thing is that you get the benefit of dollar appreciation. Okay? As much as we may want that the Indian rupee should appreciate, but I don't see that happening in the near future. Right? So you get a benefit of even dollar appreciation. Right? So you are getting a lot of things by even diversifying your portfolio. But obviously, the first step is to invest in India. The India growth story is there. India is growing. We are just talking about a small diversification of your investments.
In every day we use foreign products, right? So you gave an example of Amazon. So using foreign product, does it anyways connect to global investing?
No, not that. So basically, Amazon is now become a marketplace, right? So the most of your products which are available in India are also manufactured in India, right? So you are buying locally, but so Amazon is only a platform. So, but if you want to buy Amazon stock, right, you will have to go and buy it only from the US markets. Same thing as Apple. Now, Apple is also manufacturing in India. Hmm. But if you want to buy Apple stock, the Apple product is available in India. But if you want to buy the stock of the company, you will have to go to the US markets.
Okay, got it. Thank you. And also one thing, like if someone wants to invest into global stocks, so how big they should go, or they should keep it restricted, or narrow it down when it comes to the portfolio?
Yeah, so that's a good question. One is, like I said, first is India because that is the market you understand. That is something which we can relate to. But the moment you have crossed maybe whatever threshold, let us say, if your portfolio is now more than 50 lakhs, it could be 1 crore, it could be any amount what you are comfortable, then you should at least have 10 to 15% of your portfolio to be into global. And what I mean by global is not necessarily only US. It can be even China. It can be South Korea, Japan. It can be Europe, depending upon what are your, choice likes. You can take a multiple as a, fund which could give you most of the markets together. So you can always look at based on your preference.
Oh. Nowadays, many mutual fund houses they have stopped accepting international fund subscription. So, if one has to invest in global markets, so how one can go ahead?
Yeah, so I think that's a very good point you have raised, Harshada, because of the RBI limits, many, in fact, I think now nearly all of them have stopped accepting funds. So you have to either wait for it to open up, or the only other route is going to be through the gift city. Slightly complicated because it comes under a part of your foreign remittance, and you have to remit money over there, and a little bit more of a headache, but it is still possible to do over there. Otherwise, one just has to wait till the limits actually open up by RBI.
Okay. To close this conversation, if I ask you that I want to start investing from tomorrow, so what is that I should be focusing on?
Yeah, so I think we need to be very clear that patience is going to be very, very important. I think so. That is the most important attribute an investor will need to have. You don't need to bother about mathematical formulas or the Excel spreadsheet, because wealth creation takes time. Right? Like the saying goes, Rome was not built in a day. Right? So you need to stay committed to your path. You need to be focused. You need to let compounding work for you, because that is the true earning potential which you can have. So that is one part. The second is that do not compare. The biggest mistake investors make is we start comparing that what is the other person making and why I am not making. Everyone has a different risk appetite. So you set your own benchmark. What is the return expectation you have, and be focused on that. Along with that, what happens is that you also need to be always mindful of taxation and inflation, because at the end of the day, what you need to make money is beyond that. So that is very important. Otherwise, your wealth journey will be like, you're running on a treadmill if your real return is zero. Hmm? And if it is negative, then you're going backward, right? So you need to be mindful of that. The fourth important part is that you need to ignore the noise, right? So you need to stay focused. There'll be a lot of negative news which will float around. Negativity sells much more than positive news. So you will need to be very careful, specifically on the social media platforms. So you'll need to see what is right and what is wrong. And ultimately, it is your money. So you'll need to decide very carefully. The other thing is also invest globally. The world outside is also much, much bigger than what we have. So we should not ignore that as an investment. Take advantage of the dollar appreciation. We should take advantage. And the most important thing is that equity and mutual funds you should not ignore. Those are going to be your wealth creator engines. Debt will be a stabilizer, but the real growth will come from equity and mutual funds. Do not ignore mutual funds. Do not ignore equity also. If mutual fund is also a part of the equity market, right? It will help you to create, from income to wealth. Like I said, equity is more of wealth to wealth. It is actually even generation to generation. So equity is passed on from one generation to another generation, because it takes time for your equity to compound, and that also takes the same amount of time. So these are the key things which one should bear in mind.
So thank you, Juzer. This was really a practical conversation. A big takeaway for me today, and I guess for the viewers as well, that is that the best time to invest was yesterday. If not yesterday, then today. And also that if one has to invest, invest with conviction and not confusion.
Yeah, you're absolutely right. Thank you.
In last episode, we talked about what investors should avoid. If you haven't watched the video, click on the I button. In this episode, we discussed what you should do. Be mindful of inflation and taxation, understand the wealth creation loop, diversify properly, be patient, and think globally. The message is very simple. Wealth isn't created by chasing the highest return every year. It's created through clarity, discipline, patience, and the right framework. Thank you all for watching the Investing Mindset. See you in the next episode.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully